just put together a few slides to talk a bit more about the debt service coverage ratio. I know it was mentioned in both presentations, and we'll just run through sort of the definition and just maybe an example. So the debt service coverage ratio, or DSCR, is a ratio that's really used to measure a business's capital capacity, its potential for managing debt. And so generally speaking, if that ratio is higher than 1, it means that there's money left over after making principal and interest payments. And so just the basic formula for that is EBITDA, earnings before interest, taxes, depreciation, and amortization, divided by interest and principal, or just total debt payments. So if we just unpack that a little bit, EBITDA is probably one of the more popular profit metrics used in financial analysis. And really what it is, it's just a very quick way to get to how much cash did a business generate. And that calculation, it's saying, look, we don't care about the interest payments. Those are associated with capital. That's not the business doing anything. Taxes, that comes after the business has done what it needs to do to make money. And depreciation and amortization are these two non-cash expenses that are really used for tax purposes to reduce the amount that you pay in taxes, and also to account for, in the case of depreciation, how much you might need later on to replace a physical asset. So in the calculation, this sort of cash flow that the business is generating from its operations is key. And in financial projections, that's probably the most important number to be getting to, besides just revenues. But below that, we still have interest and principal. And the key thing to just note there is that it is meant to account for either all of the debt obligations of the business. So this includes lines of credit. This includes if you're leasing a vehicle, that's a liability. That's money that you owe. It needs to account for that. And that, principal as well, even though interest might be a small amount, if you have to make these big payments back, do you have the cash flow to cover those bigger payments? As a loan changes from one form, it might be just interest initially, but then once you have those principal and interest payments, it might change massively. So if we break that apart, sort of just even more explicitly in an income statement, so when looking at financials, you have revenues at the top, and then you have the cost of goods sold, whatever it is. In the case of a food business, that's all of the ingredients that go in to make the product. That takes you to gross income, is what's left over. And then we have what I'm categorizing as cash operating expenses. And so if we pull apart what that means, it's all of the payroll, all the labor, any supplies, rent, utilities, insurance. This is paying for the point of sale. If you're paying for a vehicle, all of these things are things that are sort of paid for in the regular course of business. And, they come out as you go through a year, as you go through a week, as you go through a month. And what's left after you pay all those expenses is that EBITDA, that earnings before interest, taxes, and depreciation number. And again, this number is the most important, but once we get to this number, there are still other things that the business needs to pay for. And so those other expenses that I mentioned before, depreciation, amortization, they are also considered operating expenses, but they're not cash payments. You don't need to pay depreciation. You don't need to pay for amortization of its intangible assets. These are not expenses that the business needs to give anyone money for, but they are expenses that you go to the IRS and say, hey, I'm recognizing this expense. And so just a quick note on depreciation is that depreciation is associated with physical assets. So if I buy a car, I might be using that car for the next 10 years. And so depreciation would say, hey, every year for 10 years, I want to recognize 1/10 of the cost of that car. And I sort of think of it like a fake savings account, where every year, if I saved 10% of the cost of my car, 10 years later, I can just replace it. And so that is really what depreciation is capturing, is that at some point in time in the future, I'm going to need to replace this physical thing that I have. And so the IRS says, cool, you can put that in your taxes as an expense now, and then sure, we can deal with it in the future when you actually need to replace it. And amortization is slightly different in that it is doing the same thing as depreciation, but it's only looking at intangible assets. And there are really, I'd say, sort of fewer intangible assets that you might think about. But intangible assets are something like, if I buy a business, someone wants to sell me their business for $1 million, but I know and they know that the business is only worth $800,000. If I pay them that $1 million that they're asking for, $800,000 of that might be sort of actual, sort of tangible physical assets, things that have very clear tangible value. But that extra $200,000 that I paid is an intangible asset, and we need to do something with it. It can't just sit there. And so we amortize it, and the IRS again lets us do that, where we recognize that expense over time and say, hey, that extra $200,000 that I paid, it's called goodwill in accounting. I want to spread that out over 5 years and recognize $40,000 a year in expenses to reduce my taxes. And you're allowed to do that, or depending on what the specific rules might be in a specific example. So we've gone from revenues, cost of goods sold, gross income. We get rid of cash operating expenses. EBITDA is what's left. Once we get rid of these non-cash expenses, we're looking at the rest of the income statement with operating income, these interest payments that are going to be important to calculating the debt service coverage, taxes, depending on how they're calculated, net income, and then the last bit is principal payments. And just noting that principal payments don't appear on the income statement. I put that line here just so we could see it in the rest of the picture of this fake business. But this will not show up in the same place when looking at financial statements. So if we take this income statement, this flow from revenues all the way down to net income, and look for what we're after for calculating the debt service coverage ratio, we see, okay, great, there's only 3 lines here that we care about. And in this case, I picked numbers that were tied to $200,000 being borrowed at 4% interest. And so in that first year of payments of principal and interest, that is $8,000 in interest payments and $36,925 in principal payments. And so that total of $44,925, if I take 100,000, the EBITDA, and divide it by that 44,925, I get that the debt service coverage ratio was 2.23. And now I think, like we were speaking about before, that's above 1, which is good. It's even above 2, which is even better. And really what it's saying is, great, if we look at all these expenses in the business, I was able to pay my cash expenses, I was able to pay these non-cash expenses, I was able to pay my interest expenses and my principal payments, and I still had some left over. to cover what was left. And so generally as a lender looking at this, it's to make sure that the business is not going to run out of cash at the end of the year because they're making payments. And so higher is generally better. So when thinking about the lender perspective, maybe there's a few other things that are important. A good debt service coverage ratio is really about the risk and how much tolerance one has for risk. You know, a baseline might be that 1.25 because there are other things like taxes and needing to have the owners take a little bit of money out of the business that might be worth considering. But you know, if we're thinking about a bank, yeah, maybe 2 times as much money as is needed is what they're looking for. You know, a big thing is that you need to look at this ratio over time. It's not just look at one moment and that's it. The debt service coverage ratio should change over time. And in general, you expect it to grow as the business grows and as it pays down its debt. And then it might have capacity for new debt because of that. And I think the big thing is that it is not the only metric that is important to a lender. I think, like I was mentioning before, for the Pearl presentation, having a lot of cash available to cover debt and reduce the importance of a high debt service coverage ratio. Having a business that has a very small amount of debt relative to the rest of how it's financed can be another thing that reduces the need for a very high debt service coverage ratio. But it's always being very sensitive to the cash in the business. And that's really what this is a measure of, is how much cash and cash flow and liquidity is there available in the business. You know, on the other side, after sort of a loan is made, this might be a metric that starts to decrease if there's going to be challenges for the business making payments in the future. And, you know, many banks, many just lenders in general might use a debt service coverage ratio as a way to define default. I know for most banks, if the debt service coverage ratio for a commercial loan falls below 1.1, that loan is in default. Even though the business might not have missed any payments, they want to make sure that there's low risk of potentially missing payments. And so this metric helps capture that. And then on the other side, thinking about businesses, it's also useful as a planning tool where, you know, if you're looking forward at your budget and your debt service coverage ratio is less than 1, saying, hey, there isn't enough money left over to pay debt and pay everything else. These are times when you might be encouraged to communicate with lenders to refinance your loans, or at least communicate, hey, I'm having these challenges. If it's exactly 1, it basically means you just barely squeak by. And that means there's really nothing else left. There's no cushion, there's no payments going out to anyone else. Everything, all of the profits are just going to take care of lenders, to take care of debt. And then we move into this next small range of, you know, if we're in that middle ground where we're not quite just squeaking by, but we are still kind of just squeaking by, this is where, in my mind, I think for a business, most of the time you're thinking about saving these dollars instead of paying them out, and instead of taking on new capital, depending on the situation for the business. And then we have this next section that is, okay, well, you're above that 1.25 threshold, and maybe you sort of have made it all the way up to 2 times coverage where you have a lot of extra left over. And this is where, yeah, it's much easier to have conversations with lenders. It's much easier to figure out how you can pay shareholders and investors out of those extra dollars that are left over after making those debt payments. And then, you know, if you're in a different position where you're sort of well above that 2 times coverage, this is where I think you might be thinking about more aggressive growth. and saying, hey, there's a lot of space here, I can take on more. What investments can I look at in the business to move even more quickly? And I think the big thing that I think a lot of people, it's sort of challenging. I mean, even for myself, the relationship with debt, I don't particularly like it. I never grew up liking it. Don't owe anyone anything. On the other side, debt is not bad. It just needs to be treated with responsibly. And so in my mind, these sort of positions where there's a lot of capacity for it just means, this is how you evaluate how much you feel comfortable taking on. And so thinking about it as a business, these are those sort of positions where, okay, take on more quickly, more aggressively. So with that, just a very brief presentation, but happy to take any questions, and we move from there. But I don't know if there are any. Nope, those are just good night messages.
Thank you so much, Chris. Yeah, we'll just wait a couple of minutes, let people kind of gather their thoughts. A lot of information, and I think also presented very accessibly. So just want to give people a couple of minutes to digest and think of any questions. And as we do this, just want to say again, thank you. This is Chris Hunter, who is joining us from LEAF. LEAF is Local Enterprise Assistance Fund, one of Ujima's peers. Excellent organization. Their large history is lending to co-ops, but correct me if I'm wrong, Chris, I understand in Boston, they also lend to companies in addition to co-ops. So yeah, maybe while we wait a couple of minutes as people gather their thoughts, could you just give us a quick kind of overview of LEAF for anyone who's unfamiliar with your organization?
Yeah, sure, happy to. So LEAF is a community development financial institution. We are based in Boston. We were set up back in 1983 to support cooperatives, specifically worker cooperatives at that time. And from there, we grew to support other kinds of cooperatives, food co-ops, and housing cooperatives. And then, as you said, really looking back at 2015, 2016, we started focusing more on BIPOC-owned small businesses, mostly in Boston, but at this point, we're able to work across the state. So we're a loan fund, but we try and help businesses raise capital from wherever it is best for them to raise capital. I think that's the most key thing, is just making sure that people get access to the best dollars that they can access. And LEAF, other things that we work on, we're the lead administrator for the Massachusetts Food Trust Program, which is a healthy food financing program focused on food retail in Massachusetts. And we also do a lot of work with community land trust and trying to build up that ecosystem, just because, if you think about the Boston real estate market, both on the residential and the commercial side, there's a never-ending wave of capital that is happy to displace businesses and people, and I think it's good to make sure that the community has a hold and a stake. So I'll leave it at that on the LEAF background.
Thank you so much, Chris. And I'll just add, we ask our businesses who they are able to get pretty helpful technical assistance from. This helps us build out our technical assistance network. There's some technical assistance, for example, in marketing that we think we can provide directly, but we are also in a resource-rich environment. And so rather than trying to do everything ourselves, we also seek to create partnerships with technical assistance providers, value-added partnerships with our businesses. And so one of the ways that we can learn about what's high quality and what's been helpful is to ask our businesses who they've gotten some good help from. And LEAF is an entity that has been named a few times by businesses in our alliance. So Chris is here on behalf of the Pearl. Chris has been working with the Pearl just on their companies in general, which is what positions him to talk with us about some of the financials tonight. And again, we thank you, Chris. Just want to make sure others in our network know about LEAF as an entity. So it looks like we don't have any questions. So I think we can close out for the evening. Before we close out, we have gotten a couple of votes, so thank you. I will drop the ballot in one more time. Again, for anyone who's present tonight who says, I don't need to wait until the investment opportunity report comes out. I've gotten enough information on the credit memo. I know what I need to know about the businesses. I'm ready to vote now. Dropping that in the chat. And then I believe I'm to hand it over to Yusuf, I think, who is going to close us out tonight. And if it's not Yusuf, whoever is supposed to close us out, go on ahead and grab the mic.
Yeah, I could do it.
All right.
Thank you guys. Thank you all for being part of this and just listening and to the credit memos. Hope you have a wonderful night, and I hope you learned something new, and hope you could go out and vote, and so we can get this thing rolling. Ujima's growing as a network, and it's beautiful to see. So thank you.
Thank you so much.
Have a good one.
Good evening, everyone.
Bye.
Bye.